Hello everyone and welcome back to Nonprofit Auditor Points. I'm Irina Ryshkova, your nonprofit auditor. In our last episode, we discussed fixed assets policy and capitalization thresholds. We were talking about how organizations decide what type of purchases should be capitalized and why consistent application of the policy is critical. And today we're moving to the next topic, from policy into practice. Once the organization determines that assets should be treated as a fixed assets, what should we do? How actually that assets should be recorded? That sounds very simple at first, but in practice in this area where nonprofits make a lot of mistakes. Sometimes nonprofits capitalize things that should be expensed, and other times nonprofits expense costs that should become part of the fixed asset. So very often the confusion comes from focusing too much on each individual invoice or each individual payment or the check instead of focusing on asset itself. Payment for the asset, it's not necessarily the cost of the asset. So today we're going to talk about what costs actually should be capitalized, what costs should not be capitalized, what repairs versus improvements, capital improvements, how we decide one way or another, what is the common misclassifications issues, and timing consideration related to fixed assets. Let's start with the most important concept under general accepted accounting policies. And first of all, fixed assets is based on the assets itself and its intended use, not simply when and how cash was paid. It is very important distinction. Many people naturally think we paid an invoice, now we have an asset, and that's really not correct. From accounting standpoint, it does not work this way. Suppose nonprofit purchases a new computer through financing, meaning it was not paid fully, it's financed. Nonprofit will be paying it over time. The organization may only make a small down payment initially and pay the remaining balance over the several years. Even though the full amount has not been paid in cash, the copy itself may already need to be capitalized as a fixed asset that belongs to nonprofit. It does not matter if it was paid in full or it has been acquired through financing, because the asset was received, and if it's used in operations, it's already fixed assets for the full cost. At the same time, unpaid portion may be recorded also as a liability, and it will be paid out when the cash is paid, but it has nothing to do with the recording of fixed assets. Opposite situation may also happen when organization may pay a deposit or prepayment for equipment that have not been yet delivered or installed. In this case, simply making a payment does not mean that the organization has a fixed assets. No, it's a prepayment or work in progress, but it's not the fixed assets that needs to be depreciated yet. Accounting depends on the conditions and the status of the fixed asset itself. And this is one reason organization needs to have a good procedures around fixed assets recording, and that's why bookkeepers should be informed what actually happening to asset itself. Is it done? Is it put in place in service? Should we start depreciating it? Now, let's talk about what costs actually become part of the fixed asset. Many people think that only purchase price gets capitalized. However, under GAAP, general accepted accounting principles, cost of fixed assets generally includes all, and I repeat, all necessary costs required to place the assets into service and be prepared to prepare the asset for its intended use. It's very important. Let me repeat it. Under GAAP, the cost of fixed assets generally includes all necessary costs required to place the asset into service and prepare it for its intended use. For example, the purchase price itself, then shipping, installation, assembly, wiring, any setup costs, and testing necessary to make asset work, everything that needed to put the assets into operation for its intended use are included in the cost of the asset. And we depreciating an asset together, not as separate charges. Let's use practical example. Suppose nonprofit purchase a large commercial copier for the office. There is a cost of the copier, shipping charges, installation fees, and maybe setup costs from a vendor. All of these costs will become part of the fixed assets, and they will become like a one number that later will need to be depreciated. Now compare that to something like employee training. Suppose the vendor also charges for a training session, teaching staff how to operate the copier. That training cost is not usually capitalized. Why? Because the training itself, it's not necessary to make copier operational. Remember that we only capitalize costs that are necessary to bring the asset for its intended use. Training, it's not. You in theory, employees could have been trained before. So the copier is already functioning without the trained employees. The training relates to the staff education, not the condition of the asset itself. So training costs are general expense separately. Maintenance agreement, for example, for that copier, nonprofit can, for example, sign a maintenance agreement that vendor will come in and fix and maintain the copier, let's just say every quarter. Maintenance agreements are also not part of the make asset to put in operating use. This is just simply regular maintenance, and it needs to be expense. So if the organization purchases 3-year maintenance agreement together with the copier, the maintenance agreement itself, it's not part of the fixed assets, and it relates to future service, and maintenance expense will be either expense this year, or if it's prepaid for 3 years, it will be prepaid expense, different type of asset. Therefore, the organization need to sometimes even split the invoices, because some invoice will be part of the fixed assets and some invoice might include part of the maintenance agreement for future. Therefore, it is critical not just look at invoice, but understand what those charges for. In practice, there is another common area of mistakes. Sometimes organization capitalize the entire invoice without reviewing individual components. Other times, organization expense the entire invoice without capitalizing necessary parts. Okay, so now I think it's a good time to talk about repairs versus capital improvements, because they're very similar by nature. We're not buying a new asset, we're either improving it or repairing it. If we're repairing, it's expense. If we're improving it, we capitalize. This distinction creates a tremendous amount of confusion in practice, And repair generally keep assets in a normal operating activity. Regular repair do not prolong or prolong the useful life of the asset or improve the asset. Improvements, however, either significantly extend the useful life or improve functionality, increases the service potential of the asset. So repairs are just simply expensed. In terms of cars, changing oil, washing, do regular maintenance, those are repairs and they simply expense. Improvements, they capitalized. Typically, repainting the car, if it's just really, or oil change, or replacing small parts, those are ordinary maintenance. But replacing the entire roof, upgrading electrical systems, renovating office space, installing major building systems become capital improvements because they either significantly prolong the useful life of the asset or even improving it. Sometimes the distinction is not very obvious. For example, replacing a small section of the carpet after damage may be just repair. But replacing flooring throughout the entire facility during the renovation project may be capital improvement. So organization often needs to evaluate the scale of work, whether useful life of the floor is extended, whether functionality is improved, and whether the asset service potentially increases. Another area sometimes where nonprofits struggle with is reviewing expense account for misclassified fixed assets. We as auditors, we are often looking at accounts such as supplies expense, small equipment expenses, IT expenses, repair and maintenance, facility and related expenses to see if there's any costs that potentially should have been capitalized or accidentally expensed. Organizations sometimes purchase significant equipment and accidentally expense it simply because it was coded incorrectly through accounts payable process. And opposite sometimes happens. Sometimes organizations capitalize routine maintenance costs that should remain just ordinary operational expenses. Proper accounting recording fixed assets, it's not only about understanding the rules. It also depends heavily on careful review procedures. So even if one person incorrectly coded expense to fixed assets, hopefully if there is a proper review procedure, it should be caught. Or at least at the end of the year when the books are closed, somebody needs to review fixed asset schedule and agreed to general ledger details to see what assets were capitalized and if it agrees with the general ledger detail. Let's talk briefly about timing, because timing is also important and creates various issues with fixed assets recording. One of the most important concepts here is that fixed assets accounting follow the asset itself, and the organization intends operational use of the assets, not simply when the payment was made. So for example, suppose the organization purchased a copier in January, but installation will be not complete until June. Once the organization receives a copier with the intended use in operation, copier itself may already qualify as a fixed assets. However, until the copier is fully installed, operational and ready for its intended use, the fixed asset has not yet been placed in service. Therefore, it should not be capitalized. So placed in service concept is very important because that's when the useful life of the assets start. We will discuss placed in service issue and construction and process in more detail in later series, because they are very critical for maintaining depreciation and maintaining depreciation schedule. But today, before we finish episode, I want to summarize main ideas. First of all, fixed assets accounting focuses on the assets and its intended operational use, not simply on the cash payments. Cash payments is irrelevant to fixed assets maintenance. Organization generally capitalize purchase price plus all the costs necessary to put the assets into service for its intended use. Organizations usually expense training, maintenance, repairs, service contracts. Those are not capitalized. And another important idea from today's episode is that fixed assets may exist before it is placed in service. Once the organization receives the assets with intended use in operation, the assets itself may already qualify as an asset. However, depreciation does not begin until the assets is put into service. And that naturally brings us to the major topic of the fixed assets, depreciation. What is depreciation? How is it calculated? Why nonprofits record depreciation every year? What does accumulated depreciation mean? All of that we will discuss in our next episode, and we will discuss depreciation basics, how depreciation work in nonprofit financial reporting. Thank you so much for being here with me today. Hopefully it was useful. Have a wonderful day and be safe.